This is the first lesson of Unit 2, which is on financial literacy. This first lesson is on banking. We'll start by talking about what is financial literacy and why is it important? Why are we learning it? Financial literacy is the ability to understand and effectively use various financial skills like personal financial management, budgeting, investing, etc. It's important because it allows you to make informed and effective decisions about your finances so you can be financially stable. Life is quite expensive and finances can get quite complicated. It doesn't matter how much money you have. It's important for every single person to be financially responsible. Financial literacy is a fairly new addition to the curriculum in the last couple of years, and I think it's a very important addition because it's something that everybody deals with. For this lesson about banking, we'll start by identifying what financial institutions are. A financial institution is a company that deals with financial transactions like deposits, loans, investments, currency exchange, etc. The most common financial institution that you'll know of and that you'll use would be a bank, but there's also credit unions, loan companies, investment companies, etc. We're going to focus on banking today because that's what you will use most often and the soonest from now. So which banks can you name? Here is a list of the common banks in Canada with their logos on the sides. You probably recognize most of them. I use BMO, Bank of Montreal, but there's also RBC, CIBC, HSBC, lots of acronyms. There's TD Canada Trust, Scotiabank, and Tangerine. These are the most common banks in Canada, but there's some others as well. What do banks do? There's lots of things that they do. First, they store your money. It's somewhere to safeguard your money instead of just like leaving it under your mattress at home. They provide financial incentives for you like interest. We'll learn more about that in the next lesson, but keeping your money with a bank can actually earn you more money in the form of interest. Banks also do currency exchange. So if you're traveling to a different country, you can exchange your money into a different currency. It's also helpful to exchange money between people or companies. So if you've ever done interactive e-transfers before, or interact e-transfers, that's when you're sending money to and from people. You can also exchange checks. So maybe you're writing a rent check for your landlord and you're transferring the money that way. Or maybe you get a birthday gift and it's a check that your grandparent has written you. You can also pay bills through a bank as well. So it's all just different ways to exchange money between different people or businesses. And banks also handle investments, so you can make more money, loans, so you can borrow money, and mortgages, so you can purchase a house. We'll talk more about those in the later part of this unit. Some of you might already be a part of a bank. You might already have a bank account. If so, you might have a checkings account. This is for day-to-day expenses. So your debit card is connected to your checkings account. You can, like the things that let's say you're going out to eat food, that money is usually coming from your checkings account. It's called a checkings account because you can write checks from this account. People don't really write checks very often anymore. The most common situation where you're using checks is probably paying rent. You might give all your checks in advance to your landlord with the rent for each month. But that's why it's called a checkings account, because the checks are connected to this account. And so people can cash your checks and take money from that account. As well, often your paychecks go into this account. So like for me, I automatically get my paychecks twice a month and it goes right into this bank account for me. There is no interest earned on the money in your checkings account because it's often going in and out. This comes hand in hand with a savings account. This is for saving your money. It does have an interest rate. It's usually pretty small, like around 1% or less, but you can earn a bit of money on the money you keep in your savings account. Whereas the checkings account is for day-to-day expenses, the savings account is you want to keep it in there and save it, and you want to try your best to not take it out. So what are the costs of banking? You'd like it if it was free, but unfortunately, there's a lot of fees and costs that can come along with banking. The first would be an account fee. This is often just a monthly fee for the ability to bank with that company. Usually it's around $10. The good news is this is often waived for students and youth, or if you have a mortgage with the bank. So you can often get by for many years without paying account fees. There's also transaction fees. So some different account plans charge you for every transaction over a certain amount. So for example, your plan might be you get 30 free transactions a month. So you could withdraw or deposit money into your account 30 times a month. So like once a day. But anything after that, you get charged $1 per transaction. Other examples could be an e-transfer fee. So if you're sending e-transfers, it could cost you $1 or $2 every time. And there's also sometimes fees if you're taking money out of your savings account. The goal is to keep the money in there. So if you take out money from your savings too often, you could get charged for an example, like a $5 fee every time you take money out of your savings. There's also ATM fees. So ATMs are just like the small machines that are like often at restaurants or schools or bars, and you can use the ATM to take out cash from your bank account. If you're using, like, ATMs are made or like sponsored by, I guess, by different banks. So there might be an RBC ATM and I'm with BMO, I can still use that ATM, but I have to pay an additional fee because I don't have an account with them. And that might be like $2 or $3. So if you use an ATM from your bank, then it usually doesn't cost you. But if you use an ATM that another bank has, then it will probably cost you. So here's an example. Let's say this is your bank account plan. Your monthly fee is $8.75. The first 25 transactions in a month are free, but anything after that, they're 75 cents each. If you use an ATM from another bank, it costs you $3.50. Your first 5 e-transfers in a month are free. Everything after that is $1.10. And you can transfer money out of your savings once a month. Anything after that, you also pay a fee of $6. So this is just, I mean, I made this example up, but this could be a very standard situation at a different bank. So the question is, create 2 different scenarios of your monthly bank transactions and determine how much these scenarios would cost you. So let's say this is case A. There could be all sorts of different scenarios that you have depending on the person and what your spending habits are. So the monthly fee, you have to pay that regardless. Let's pretend we do exactly 25 transactions. So we know we only have 25, so we make sure we don't do any more than 25 withdrawals or deposits. So that doesn't have any extra charge. Let's say we use another ATM once, so that's a $3.50 charge. Let's say we send 10 e-transfers in a month, and so we only have 5 for free. So the 5 on top of that are each $1.10. So that's another $5.50. And lastly, let's say we transferred money out of our savings twice. So the first time was free, the second time it cost us $6. So if I add all of those up, that means my bank fees in that month were $23.75. That might seem low, but over a year and over time, that adds up quickly. I won't go over this in detail. You can look at it later, but this would be another example, case B. Maybe this is a different person. They have slightly more transactions, slightly less e-transfers. This might be a month for some person. And in this case, it costs them $25.50. So you can see, you can play around with the numbers to see, okay, if I do this many things, it costs me this much. So if you're looking to, maybe you don't have a bank account yet, and you need to figure out where you want to put your money. Which bank do you choose? There's pros and cons of each bank, but they generally have the same services. So these are the questions that you should ask when you're choosing a bank. Are there account fees? How much is it going to cost you each month to bank with them? Are there any deals for students? There often are. What's the interest rate for savings account? Maybe one bank has a 2% interest rate and the other has a 0.5% interest rate. You probably want to go with the higher one. How accessible is online banking? Do you have an easy to use online app? Or is it some complicated online system that crashes all the time? Most of the time you're going to be doing your banking online, so you want it to be accessible. Is there a physical location close to where you live? So maybe you want to be going to the bank to drop off, like to drop off money, to deposit cash or whatever. It might be helpful to have a physical branch location close to where you live. And lastly, you might ask, are there any joining incentives or promos? Often you'll see promos like maybe they say, come bank with TD Canada Trust and we'll give you $200, or we'll give you no bank fees for a year. Whatever it is, they want people to come to their bank. So look out for those promos and incentives, and that might help you choose which one to go to. We're going to talk about debit cards and credit cards next. So if you have a Chequings account, you probably have a debit card. This is a plastic card you can use to purchase items. So money comes directly out of your checkings account automatically when you use your debit card. You can also, so if you're at like the grocery store, you can buy stuff, tap with your debit card or use your PIN and you purchase the items, it comes right out of your checkings account and you're done. You can also go to an ATM and take out cash. So if you're at a restaurant and you want some more cash for whatever reason, you can use an ATM machine and the cash comes right out of your checkings. Debit cards have a PIN, I think it's personal identification number. This is for protection of your card. So if your card gets stolen, people can't just use it. They have to enter in a PIN. So never share your PIN with anybody, because if they have access to your PIN and they take your card, they can spend your money. So here are the pros and cons of using a debit card. Pro, they're super convenient. You don't have to bring cash everywhere. You have just this one card and then you can buy whatever you need from that. It's also really easy to track your spending. If you're buying things in cash, it can be easy to forget what you've purchased or where your money has gone. But if you pay with your debit card, you get an automatic bank statement that tells you where all your money went. But some cons of having a debit card, it could get lost or stolen, which means someone could potentially have access to your bank accounts. But usually the banks are really good about it. If you lose your debit card, you call them, they cancel it, and it's not a problem. Another con, you might be tempted to spend more. If you have like physical cash in front of you, it's a better visual of how much money you have left and how much you can spend. Whereas if you have a card, it's a little easier to get away with, oh, I can buy this and I can buy this. And then you go check your account and you have almost no money left. Another con is that sometimes there's fees associated with it. So again, if you're using different ATMs, if you're using too many transactions a month, then you could get charged. But overall, debit cards are super useful. Next, we've got credit cards. And to understand credit cards, we have to know what credit is. Credit is money that you use now, but pay for later. A credit card is a plastic card with your unique account number on it, and you can use it to buy things. So you tap or swipe, and you purchase items immediately. But this is different from a debit card because it doesn't come directly out of your account. You don't actually pay for this until the end of the month. So you're building up, you're spending your credit every time you tap your card. And then at the end of the month, you transfer money from your checkings account to pay off your credit card. So some major credit card companies that I'm sure you've heard of, MasterCard and Visa would be the most popular ones in Canada. You have to pay off your credit card on time or you risk paying interest and ruining your credit score. Credit cards can be super risky for this reason. It can end up costing you a lot of money. So what is a credit rating or a credit score? It's a score assigned to every person using credit that shows how trustworthy they are with paying back their debits. I think I meant to say debts there. Your credit score goes down if you miss any credit payments or if you're late on making these payments. And your credit score slowly goes up if you continue to make your payments on time. This is super important for future rental agreements, mortgages, or loans. When you're doing these things, they often look at your credit score to say, is this person trustworthy? Should I let them rent this apartment from me? Because if your credit score is bad, they're probably not going to want to let you sign a rental agreement with you. They don't want you to rent from them because they don't believe that you're going to pay them rent on time because your credit score is bad. It also helps determine the interest rate you're going to pay. So let's say you take a loan out and you have a super bad credit score. One, you might not even get approved for the loan if it's really bad. But let's say you do get approved for it, your interest rate will most likely be higher if your credit score is low than if your credit score is high. Because the bank is saying, okay, I don't really trust that you're going to pay this back to me. So I'm going to charge you a high interest rate. So just in case I don't get my money back, at least I've got some high interest along the way. So having a bad credit score can really seriously harm you. This is a video about credit cards and kind of how they work, but I'll link it and you can watch it later on your own time. Ooh. There we go. Okay, here are pros and cons of credit cards. So one, they are super convenient. I like them even better than debit cards because you can just tap all the time. You don't have to have anything else with you. And it's just very convenient. You don't have to bring cash around. You don't need anything else. It's super easy to track spending, just like with debit cards, because you have your bank statement or your credit card statement at the end of the month, and it lists all the things that you've spent. Credit cards are also useful because you can shop online. You can buy anything online using your credit card. Otherwise, unless you have PayPal, you're not able to do this. Some other pros of credit cards is there's often perks and reward programs. So you may have heard of Air Miles. That's one that I have. So every time I buy anything on my credit card, I earn Air Miles on it, which I can eventually use to buy a plane ticket somewhere. There's all sorts of other reward programs available with different credit cards. Some cons, though, again, it could get lost or stolen. If someone steals your credit card, they can rack up a really high bill and then you're stuck with it. But again, often the credit card companies are insured for this problem. You can cancel it just fine and it gets all sorted out. It's very easy to get carried away with spending when you have a credit card. With a debit card, it can be kind of easy to get carried away. But a credit card, it's super easy because the money's not coming directly out of your bank account. So you can very easily spend way more money than you have. You rack up a high credit card bill by buying a bunch of stuff, and then you go to pay it off at the end of the month and you don't have the money to do so. And that's when you get in trouble. That's when you get really expensive interest charges if you're overspending. The interest rates on credit cards can be around 19%. So you have, like, let's say you have a $100 credit card bill that you can't pay. Then the next month, you still owe that $100, but you also now owe another $19 of interest. But now expand that, and let's say you have a $3,000 credit bill. You can see how the interest gets really high very quickly. 19% is very high. So if you have a credit card, you have to make sure you're using it appropriately. And then yes, it can be convenient, but you have to be smart about how you're using it. So that's kind of our introduction to banking and the different bank accounts, the pros and cons of each, and the main cards that you use with banking, which are debit cards and credit cards, and the pros and cons of each of those.